Hi, friends. So, in this video, I want to share the 3 lessons for why I cannot afford to not invest. And this video is really for people that are interested in learning how to build wealth and are new to investing, but are worried about how to get started or putting their money into the stock market and worrying about losing money. Before I share these 3 lessons, I'll take just a quick minute of your time. So, this video is going to be part of a larger video series that is going to go lesson to lesson and really help you understand how to invest successfully, not just what you need to do, but why you need to do it. And the why behind what you're doing in investing is one of the most critical things that you can learn because there are so many ways to make emotional or behavioral errors in investing that can really impact your success over the long term. And so, my goal is to take everything that I've learned over the last 15 years and just share lessons in a way that I wish I could have had them when I first started 15 years ago. My goal with this is to be able to release one of these videos every week so that by the end of this video series, you could watch these videos from video to video and get all of the lessons connected so that you have a complete picture for how to invest successfully, or at least how I have invested successfully and how I think most people should invest. I'll share a quick bias with you. So, my video series on investing is going to be biased towards being a passive investor. And what that means is that I don't spend a lot of time with options, which you might have heard. I don't believe in trying to pick the next hot stock. I'm not really tuned into a lot of the investing noise out there. My goal with investing for my own plan has been to always look at how can I ensure the highest probability of success over a prolonged period of time. So 10, 20, 30, 40, or 50 more years that allow my money to grow for me. So, as part of this series, these first 3 lessons are really the core reason why I have this constant, urgent need to always be investing. And it's really what inspired me to take action quite a long time ago that I wish I would have known even earlier so that I could have started much sooner than I did versus kind of sitting on the fence and worrying about investing or not. And so with that, I have a presentation for you. So I will walk through that here now. Okay, so all 3 of these lessons together are critical, but this first one is the one that I think most people get wrong emotionally and behaviorally with their money that I want to get to first. Okay, so, lesson 1 is that inflation eats away at the power of your money. And investing is a way to help protect from inflation so that your money can be purchasing more for you. So, what does this mean? So, pretty much everyone knows what inflation is by this point, whether they know the strict definition of it or they just feel it. Inflation just means that the money that you have is able to buy less and less for you. So, the carton of eggs that used to be $2 is now $4. And so you still have the same amount of money, but it's buying you less. So on this graph on the left, the Federal Reserve measures basically the purchasing power of a dollar. So what they do is they take something called the Consumer Price Index, which is a basket of goods that you can purchase, like food or how much you're paying for energy at home. And it's looking at how much can you purchase with a dollar. So what you can see is that over time, they have charted this purchasing power of money. And so what you can see on the chart on the left is let's say that you are suddenly immortal and you put money in your mattress because you don't want to invest it all the way back at the turn of 1900 here. So if that money was just sitting under a mattress over time, what you can see is that over the last 120 or so years, that money is worth less and less and less. It buys you less. And so this is one of the biggest risks for not investing is a lot of people, especially new people, are scared of losing money in the stock market. And so they keep their money out of investments and they feel safe if it's just sitting in cash, not doing anything. The truth is that that cash is at risk even if it's just sitting there. So even if it's just sitting in your wallet, 20 years from now, that cash that's sitting in your wallet is going to not be able to buy you as much as it does now. And so the solution for most people just seems to be, well, I'll just have to work more or I'll hope that I get a raise. So that is just being really focused on the first level of wealth building, which is just your cash or your money. But what you want to be focused on is becoming an asset builder. And if you want to know more about what wealth is, I'll link to a video in the top right corner where I talk about what wealth actually is, which helps you start pivoting your mindset away from just being focused on money and being more focused on assets. And so when you're investing, what you're doing is you're investing in an asset. Well, what does that mean? So, an asset is something that creates value. So, if I decide to invest in a business, what's happening is that as that business grows and it starts earning more and more money, I have the opportunity to share in the earnings of that company. So when I invest, I can protect the purchasing power of my cash because it's put into something that is also growing, just like inflation is. So let me show you the second graph. So this is an incredible chart. What it shows you is that if you started investing and you put $100 into the top 500 largest companies in the United States, and you just let that money sit there and you let it grow as these different companies grew, over time, that same $100 would be worth almost $250,000. And this is really key. That number is presented in 1920 dollars. And what that means is that it already accounts for inflation. So even though inflation here on the left is eating away at your dollars, these dollars on the right already include that inflation impact. And so even though inflation is eating away at the value and purchasing power of cash, this $100 over here has kept up with inflation. In fact, you can see that it has significantly outgrown inflation because it's invested. And so instead of just taking the long view of inflation and investing, let's turn this into something real and look at just the last 5 years. So from 2020 to now, the government has put or dumped almost $5 trillion worth of stimulus into the economy. And so this money being dumped into the economy, whether it goes to individuals or not, ultimately all it does is it drives additional consumption. And so as people are wanting to buy more with the money that the government is providing, it just increases the prices of everything. What that means is that for you and I, who might not invest, is that the cash that you already had is now worth less and everything else around you is more expensive. And so who has that really benefited? And so if we look at the S&P 500, which are the top 500 largest companies, so Google, Apple, Microsoft, many of the large names, the returns of these companies, their value has increased almost 100% over the last 5 years. And so this is kind of obvious in retrospect, but as you have a bunch of cash being dumped into the economy, people spend that cash at businesses, and then the businesses are reporting that they have record profits or revenues. And so for people that have decided to not invest, because they can't or they're scared of the stock market and they're scared of losing money, those people have seen the purchasing power of their money decline over this period. Now, people that are able to invest in the stock market and have bought consistently, again, this is a mindset thing, is like, I always need to be investing, have seen their wealth increase significantly over the last 5 years, even while most people who decide not to invest or can't are struggling more and more and more. So this is lesson one, and it's a critical lesson, is that I can't afford to not be invested because I need my money in an asset that is able to outpace inflation and grow. Now, this doesn't always work. Like in the 1970s, some companies actually declined in value as inflation was going up. So this is not a sure thing. But what is a sure thing is that if you don't invest, your cash is going to become worth less and less. Okay, so lesson two is that your money is either working for or against you. And so this really gets into the idea of compound interest and how if you allow compounding to work longer for you and you don't interrupt compounding by withdrawing money and you can stay consistent, how it can be a powerful tool in your life. So let's say that you're someone that has decided that they're going to save money for their future, but you're worried about investing. So kudos because you're able to put away money every single month. But the problem is that if you just save your money and you don't invest it and you don't allow compounding to work for you, you're basically living your wealth journey on hard mode. And so let me show you what that looks like. So for someone that decides that they're going to save $1,000 a month over the next 30 years at a 4% interest rate, what that means is that they will have to contribute a total of $360,000 over their 30-year savings lifetime. And their money over those 30 years will just about double. So basically, for every $1 you put in, you'll make a dollar. Now, this can seem really good and it's safe because it's like, look, I'm not going to put my money in the stock market. I don't want to take risk, and I just feel, safer by letting my money work slowly this way. The problem with that is that there's also risk for not investing, because the question is does this $673,000 that you're working towards, does that meet your goal for the future? And so one of the ways that we have to think about investing is, what risks are we willing to accept? So for me, when I first started investing, my biggest risk is that if I didn't invest, I actually wouldn't be able to hit the goal that I had in mind. And so it's this fine double-edged sword. So if I don't take any risk, I don't get any reward. So again, then I have to do my wealth building on hard mode, because basically every single dollar that I need to hit my wealth target means that I have to do it through my own work. And so that means that I'll probably never stop working because my money is not fighting for me. So on the right, what you see is someone that has decided to invest their money instead of just saving it in a bank account. So a few things to understand about this chart. One is that, let's say you wanted to be a millionaire after 30 years. It might seem like it's more risk on the right to put your money into companies, and you do have the risk of loss. But if you don't take the risk at all, you're not going to get to your millionaire goal on the left. So for me, when I first started investing, the thing that really inspired me to invest is I realized that if I didn't invest, I would never meet my goal in the first place. So that's part one. The other thing to understand is that this 7% interest rate is an often cited assumption about how much the stock market's grown. That 7% interest rate includes inflation already. So if you subtract inflation, the stock market's grown around 11% a year over the last 100 or so years. To account for inflation, you take about 4%, which is the average inflation rate over that same time period, from that 11%, and you get a 7% total earnings or interest rate on your money over time. The reason that's so important is because I hear a lot of investors say something along the lines of, I won't be successful because if I invest, it still won't keep up with inflation. Or even if I earn $1 million, that won't be much money for me, 30 years from now, because inflation will eat it away. The key thing to understand is that your investments are growing and hopefully outpacing inflation, so that if we use an inflation adjusted dollar, it keeps that spending power that we've been talking about. So for me, when I first started investing, I was thinking about this on the right, and I was thinking that I need my money to work for me. And if I don't start investing as soon as possible, I'm not going to be successful with my long term goal. If I let my money just sit in an account because I'm worried about investing, then I'm not going to be successful anyway. So that was a huge motivator for me to get started. Okay, so that brings us to lesson 3, is that waiting to invest really hurts. The longer you wait, the more work you have to do on your own part, and the less time that money has to work for you. And so let me walk you through an example of why this is so important. So I'm going to use two people. So let's say you have Amy, and she starts learning about money really young. So she decides that she's going to save $83 a month at the age of 18. So that's basically $1,000 a year that she's going to save. Ben, on the other hand, he starts at the age of 40. Maybe in his early 20s or 30s, he didn't really want to think about money very often. And so now he's starting in his 40s. He's decided that he's going to save $5,000 a year, which is 5 times more than Amy. The question is that at age 60, for each of these people, where do they end up in wealth? Ben is saving 5 times more than Amy for 20 years. Amy started much earlier. So let's look at this chart. Even though Ben saved 5 times more than Amy for 20 years, the additional time that Amy saved from the ages of 18 up until 40 when Ben started, that 22 years of money compounding at this 7% interest rate enabled Amy to outpace Ben's wealth. And the key thing about this is that Amy only contributed $48,000 of her own money, which turned into 230,000 versus Ben, who actually had to invest $100,000 of his own money, more than double, and he ended up with less. And if you're curious about compounding and the power of compounding and how it works, one of my first videos talks about that, and I'll link it up in the top right corner. Okay, so with that, those are the main three lessons for why I'm always thinking about investing, is because I can't afford to let my money get eaten away by inflation. I can't afford to sit on the sideline because obviously we all have limited amount of time on this world, and I want my money to be fighting for me and growing along with me. And I know that the longer I wait to start that process, the more money I'm going to have to put in on my own, which includes basically just my sweat equity, the amount of time in my life that I'm trading for a dollar when I'm working versus my money being able to fight for me and grow on its own. And finally, the realization that for me, when I started really getting specific, which I'm going to get into in a future video, about what my investing and wealth building goals actually were, I realized that with the amount that I could save, I wouldn't be successful unless I did invest because I had to earn a specific interest rate in order to be successful. So, this first video was all about why I want to invest and why I'm hungry to invest. And so, I will have a video out next week where we actually get into what is investing when we talk about stocks and bonds and putting money into companies and all of the trade offs that we get when we talk about risk and reward and how to balance that for your long term goals. So, wish you all the best on your money journey, and I will see you on the next video.